if your business strategy is entirely dependent of the largesse or the generosity of a large institution that is largely indifferent as to whether you survive or not, it's not much of a sustainable strategy for organic growth.
Hey everybody, this is Joe Anthony, your host of The Marketing Matchup. I'm here today with a very special episode. For the first time ever in the history of this pod, we're turning the camera and the sound on those journalists that cover the world of wealth management. Those have taken note in terms of the organic growth trends and the other marketing topics that come about as we cover the world of RIAs and wealth management. As you know, in the Marketing Matchup, our guests are usually chief marketing officers and similar types who are helping these firms lead the charge on growth. But today, we're very excited to have both Tobias Salinger and Ian Wenik, names that most of us know following their writing. Toby comes to us from financial planning, where he spent the last 10 years covering the industry. And Ian Wenik comes with his own special title of Scoopinator, running the show at Citywire. So Ian and Toby, thanks for joining us.
Thanks for having us on.
Great to be here.
So people say, why would I want two journalists who cover the space to talk about marketing? Obviously, both of you come from different. so it's a different perspective, right? But I will tell you that in my talks with all the CMOs and different people that are part of the show or angling to be on the podcast, they always ask the question like, I wonder what journalists think when the people that are covering the space actually think of all the stuff that we're hypersensitive about, which is organic growth. I'm not sure how much you two pay attention to it, but a lot of the events that advisors attend, it seems like at least every conference has one or two things about organic growth or the growth marketing playbook, things like that on the agenda. So it's front and center. So as we dive into this, we're going to get to some of those questions and maybe get your perspective on that. But let's do our audience a favor. Let's let them play dumb for a second. Maybe they haven't run into you before. Give them a quick background on yourselves. Toby, I'll let you go first. Just frame who you are for the audience.
Well, as you mentioned, I'm the chief correspondent at Financial Planning. I've been there since the beginning of 2017, and my main areas of coverage tend to be practice management, professional development for financial advisors, a good bit of regulatory and compliance coverage, as well as the ever-present M&A deals, and no shortage of diversity and equality as well over the years. Another area of this constantly changing and evolving industry. I originally grew up in Kansas City, Missouri. I live in Chicago, and I went to college at the University of Texas at Austin and graduate school at the City University of New York Graduate School of Journalism.
Very cool. Awesome. Thanks for the setup. And Ian, your turn. Introduce yourself for the crowd, please.
I'm Ian Wenik. I am the editor of Citywire RIA, which is a website that covers the independent wealth management industry on a daily basis. I've been here since 2018. We strive to break news every single day on the biggest stories in wealth management, from M&A to executive changes to technology to regulation. I've got a team of 4 other journalists around me, all of whom are stellar. And then before I got into this business, I used to write about distressed debt. I wrote about Chapter 11 bankruptcy, and I wrote about professional and college sports of all shapes and sizes. Still write about college basketball for fun on the side as a little side hobby. And then before I began working, I went to Penn for undergrad, and then I graduated from the Columbia Journalism School in 2016.
Awesome. So the two of you, first of all, thanks for taking the time to share with our audience some of your thoughts and perspectives on these things. One of the things that I want to start, it's kind of a sideways way to enter the conversation, but I think it's very impactful to talk about this, is that the very thing that you seem to cover a lot, the world of M&A. I mean, obviously the deal traffic is obviously something that's in focus. A lot of marketers I talk to say it's because of the intense environment around deal making and firms racing for scale with deals that there's never been more pressure on organic growth. React to that. How do you see that? Do you feel that coming up in conversation? Can you extrapolate how you might interpret that from your seat? Ian, I'll give you the first shot at this one.
Man, that's a really good question. I mean, to be honest, I think that marketing is sometimes something that I kind of take for granted. And the ways in which I encounter it, because I'm not necessarily the end client, is through pitches from PR firms. So I have a little bit of distance, but it's funny because I think an angle that's not really covered is that a lot of these it's not just external marketing, it's internal marketing too when you carry out a transaction, right? Like you have to find a way to craft a pitch to keep the advisors on board and in the building. I mean, I think about how Peter Mallouk had to fight really hard to keep as many of the Goldman Sachs PFM advisors as possible. Part of his decision to change the business name back to United Capital, that was a marketing pitch to the advisors. The idea of giving them independence and autonomy, let them operate standalone, that was a marketing pitch. So, it's kind of how people say, oh, everything's kind of goes down to the economy, we're about politics. Maybe in a certain sense, everything about this business is about marketing in some way, sense, or form.
That's a good perspective. And Toby, how would you answer that from your seat? I know you've covered some organic growth trends recently as well. Like with your ear to the ground, how do you make sense of that idea that deal making has created pressure on organic growth?
I think it's definitely true. Organic growth strikes me as having a couple of different analogies in different areas of life. Ian brought up sports. It reminds me of the way that analytics are at the center of everything in sports, where it used to be, well, look, it's still which team won and which team lost, but it used to be what is your batting average as a baseball player, but now it's what is your WAR, what is your net efficiency rating when it's time to make the pick in March. You know, there are any number of stats out there today to assess performance, and I think there's a growing sense across the industry that M&A activity and stock and bond and other asset value appreciation is driving a lot of that growth. I think a few years ago, that was something that sort of semi-cynical industry observers would say to me on the sidelines or something, or just mention it in passing as I interviewed them for a story or something. Now I think it's just widespread acknowledgement that, hey, show me the actual growth net of the market appreciation, net of the M&A deal. And that's where you get that, there's some debate about the term of what is exactly organic growth. But the point is that people are saying, okay, let me look beyond just the AUM of this year versus the AUM of that year. How else did you generate growth? And you must be alluding to a recent story I did about this, about the relationship between marketing spend and organic growth. And we can go into the conclusions a little bit more, but the basic takeaway was that marketing spending, sophisticated marketing spending, leads to organic growth. And that goes beyond just buying firms and the growth in the stock market, adding to those figures. And I think more and more people around the industry are acknowledging that and wondering, am I growing organically, or am I just buying up firms and recruiting financial advisors? So I think it's an important question.
Well, I would say that for the purpose of this conversation, when we talk about organic growth, I would define it as a standpoint of new assets being brought on by new clients or new assets coming from existing clients, not counting what the market gives you, right? And obviously the net of whatever drawdowns the clients have, right? I mean, that's the only way to look at it. I think acquisitions and market performance certainly have served a lot of firms and covered up a lot of blemishes in this area. But Toby, to your point, I want to build off that idea that, with sabermetrics in baseball. I think there's a topic that I've heard more and more in a live environment at these conferences, and talk about the cost of client acquisition cost. CAC, I think, if we're going to go with WAR, we'll talk about CAC as well. So in that, everyone's looking at how do I snag a client and not overpay for that client. And I think we start looking at how much money is chasing this golden goose. And I think, Ian, in your notes, you even referred to the referral programs from Pershing. Goldman Sachs is going to try to do something. ACO now, they've got, and then everyone put the heat on Schwab for ratcheting up what they're asking for the privilege of getting their referrals. And so, Ian, I'll ask you this question: when you look at these things, and you see these signals, this out there, what does that tell you as a journalist? Where either their firms trying to get into this game, or they're ratcheting up the stakes in terms of what they're charging for the lead generation?
Well, I think what it shows to me is that if your business strategy is entirely dependent of the largesse or the generosity of a large institution that is largely indifferent as to whether you survive or not, it's not much of a sustainable strategy for organic growth. I mean, I still remember way back in the day, this is a COVID era scoop that we had, but I still remember a TAMP called Sawtooth Solutions, where its entire reason for existence was because it was the TAMP for small advisors on the TD Ameritrade custodial platform. And once Schwab bought TD, that TAMP had no reason to exist anymore because all those advisors, the entire TAMP apparatus that TD had no longer existed. So I think it shows if you're just reliant on the referral programs to generate growth, that's not really a sustainable strategy. To your point, it's getting significantly more expensive. I mean, Schwab just raised fees by 5%. They increased the threshold to qualify and the minimum size of a client to send out. So the total addressable market of clients has gotten smaller too. I do think it's curious that Goldman and Pershing and Robinhood are trying to get into this space. But I think what makes it different is that Schwab, Fidelity, and TD, when it still existed, they had something different, which is that their custodial referral programs, they all relied on the branch office. And Goldman and Pershing don't have that apparatus. So are you really getting the same pool of prospects that you're paying a similar price for? I don't know what the answer to that question is.
Well, Ian, you raise a good point in terms of how the models for these referral programs have changed. Obviously, on one end of the scale, you start thinking about all the different choices out there. You know, we've seen Smart Asset and have a digital referral engine, and it's always been sort of a matchmaking service driven by their platform. And then you've got, on the other side, you got Schwab's physical offices and TD's physical offices where, you know, someone comes sit down and say, hey, you need a real full-scale wealth management shop. We're going to send you out to firm in our program. So it really runs the gamut. And I think the models of these programs are only going to shift further to the digital direction, I think, as the consumer moves that way. Toby, you're nodding along. What have you observed? What have you picked up on in your reporting as it relates to this?
Well, I think it all boils down to one of the most valuable aspects of any firm in this industry, and that's recurring revenue. When you are a part of one of these referral programs run through Schwab, Fidelity, now Pershing is coming into it. Finally, after all these years, there has been talk at various times of Pershing getting something going on this. They're charging recurring fees where RIAs are getting so much interest from outside investors because they have these close relationships with clients and the recurring revenue that comes with it. So the referral programs are coming in and getting part of that recurring revenue, and that is very, very expensive. So I think you do see more of these technology-oriented ways of getting leads. You see a lot of advisors out there who are kind of lead generators in themselves because of their social media footprint and the way they attract people in the general public just through the power of their work. But that's why they're also focusing more on their internal methods through old-fashioned client referrals and making sure that clients know how valuable that is to them. That's still the number one source of referrals is other clients. You see more firms investing in centers of influence referrals from CPAs or from estate lawyers, but there are a lot of opportunities out there just that are beyond just CPAs or estate planners. But there are more ways to do it than paying this recurring revenue back to firms who, in many cases, make it very difficult for advisors to get in the first place. I think that's probably another reason why you're seeing more entrants into these referral businesses. There are a lot of advisors out there who just can't get into the Schwab or Fidelity referral program, even if they wanted to, because A, the fees are high, and B, they have more and more requirements to get in. I think that the reporting in FP and other industry publications over the years has shown how dramatically that number of firms that are in the Schwab or Fidelity referral program has fallen. So there are fewer opportunities there. They're more expensive, and there's ample opportunity for disruption, whether in technology, good old-fashioned referrals, or just thinking completely outside of the box.
Well, I think you're right. There's opportunity for disruption. We've seen more than a handful of advisors or firms take a new spin on marketing and promoting themselves for growth, right? Obviously, the example everyone likes to use is what Referral has done, and they've created a whole events business and media business around their personas, and it's gone that direction. We've even seen Merit Financial, the firm out of Atlanta. Last year, they touted an acquisition where they bought a firm primarily because the advisor had a really great YouTube strategy, and I think your publications might even covered that deal. And I think looking at things like that, where you have firms finding ways to reach new markets, trying to connect with audiences, it isn't something where, in a lot of cases, if they can't figure out how to be innovative or different in their market, and frankly, in some cases, they're buying. People are doing really well. I saw something recently where a couple of firms were snapped up because they had great niches with surgeons and doctors, right? And so, that could be a very lucrative audience for a wealth management firm. But if you don't have an in, you need to buy that in some cases. And so, in a lot of different ways, whether it's with the referral programs or with M&A, people are buying access to organic growth, and that is sort of an interesting look at that. I'll give you a quick take on the referral programs. I would tell you that, and I'm curious to see what your reaction would be. I don't think that you should participate in a pay-for-play organic program unless you already have organic growth working for you, or you have marketing that's working. It should be icing on the cake. I don't think you can afford to squeeze margins on a custodian referrals if you haven't got something going already in the organic growth. Otherwise, it's kind of like the Walmart syndrome, where if you're selling living in the Philly area for a long time, we saw Tasty Cake. Everyone loves Tasty Cakes. That business suffocated because they used to have high margin business distributing local delis and sandwich shops, and they would make good money. And then they got a deal with Walmart, and their distribution expanded 100x. But Walmart was only basically giving them pennies on the dollar in the margins. And even though they were never bigger from a distribution standpoint, they never could really sustain themselves. They went to Chapter 11, right? And so, just the same, I think if you're a firm, you don't have other avenues for growing, you pay too much for that growth, you could be a sinking ship. And I'm sure the two of you might have seen some of those firms out there have to shuffle the deck. You may not know why they're doing it, but there's a good chance if they're making deals or letting people go, it might be because they haven't solved for that. So I'm just curious. Ian, you're smiling there. You take a look. One of the and I'm curious to see what your reaction is. This, Ian, we're starting to see the era of the CMO. The two of you covered the industry long enough to know that there's a good chunk of time where this is like a CEO-driven business where a lot of like names. I mean, still to this day. I mean, if you think about historically the last 20 years. They became almost pop culture icons within financial services. The Rudy Adolphs of the world, the Cheryl Pennies, the Joe Durans, people like that. And then it moved along a little bit, and we started seeing CIOs of these firms, chief investment officers, getting platforms. It feels like the last couple of years we're starting to see CMOs take center stage as more and more firms are pushing marketing. What have you noticed there? Have you caught on to that? Do you see that from where you sit that key marketing hires are being pushed for your attention as you cover the industry?
Oh, yeah, absolutely. I mean, I still remember, the one that I can recall personally writing about was, I remember we wrote about Great Hill Partners, the PE firm, hiring John Werns, who used to be at a Wealth Enhancement Group, now known as Wealth Enhancement. And those types of hires make sense because these PE shops are desperate to get into this space, and they're willing to pay up to hire people that have institutional knowledge around this industry and aren't necessarily going to be CEO types. So for them to hire someone like John Werns that knows this industry, yeah, that makes a lot of sense. But to your point, in a lot of ways, I think it's funny because the celebrity financial advisor drove growth and can still be a rainmaker, but the era of the celebrity CEO seems over almost. Like I think about when I first started this on this beat in 2018. I went to an event in Vegas that Market Council organized, and there was an event. It was a big like CEO panel where it was, I believe it was Cheryl Penny. I believe Elliot Weissbluth was there. I believe Omani Carson was there. And I believe the fourth person there was Joe Duran. And think about how all those people's lives change in the years since. The only one who's still operating as the head of power at the company that they led at the time is Cheryl Penny. All those other people left, whether fully by choice or not. And those companies that they left, they became much bigger than the core vision of the founding personality.
Well, it's a good point when you talk about the personality changes there. And I think those CEO visionaries as rainmakers and business drivers certainly has changed, and they've sort of delegate that out. And, Toby, going back to some of your coverage, I know last year you also ran a series in terms of on how to get started building an RIA. And you talked about how do you market as a smaller firm. So that's like the opposite end, right? The names that Ian just dropped, these are sort of, titans or kings of the RIA space, right? The flip side is, you looked at the issue from the standpoint of, okay, so you have your own book, maybe you have a couple $100 million, you're starting on RIA. What are you looking at? What did you learn in that process of that, like in terms of getting the mind's eye of an advisor trying to grow a practice, and some of the ideas and recommendations you came across?
Well, what I found is kind of comforting because the experts told me it starts from within. That was such a big takeaway talking with some of your contemporaries like Megan Carpenter at FICOM. I must have spoken to Robert Sophia at Snappy Kraken as well. I'm sorry, I think I only spoke with 3 or 4 folks. I didn't manage to get to you that time. There's only so much time in the day and space on the web page, but you probably would have echoed this as well. They said to start by thinking of your ideal client. Don't sit here and think about a Super Bowl ad or something broadcasted to 300 million Americans. Think about which people you want to attract to your firm. And I think Megan explained it in a very helpful way to me when she said a lot of times when we think about social footprints, we look at how many impressions a post got, how many people commented and liked and loved, and who knows what other emojis they might add at any time. The point is, did the right person see it? Did the person you wanted to reach see your message? And before they think about these big outlays of marketing spends and everything like that, that's a very important conversation. But who are you trying to find, and who are you trying to attract? Who's the ideal? And so that can lead you down a bunch of other questions as well, such as what niches, where, and defining that ideal client should then guide the marketing plan. And then, of course, all kinds of other questions will then come up. whether in terms of technology or who to work with, who really knows this client base well, what kinds of advisors should we hire who know this client base. I think all of these also kind of lead into the fact that marketing is such a catch-all term. It can mean so many different things. At one time, that might have been, thinking about creative advertising, like on Mad Men or something. But these days, that could be all kinds of tech roles, SEO, AI, everything there. Then the whole messaging. Then PR is a different aspect of that. And there is, I would agree, an increasing acknowledgement that chief marketing officer needs to be up there in the C-suite, with all the partners guiding the next move at the firm, because it just ties into everything that's involved with running a successful wealth management business.
You mentioned that whole idea of CMOs actually have a real place in the C-suite. There was a statistic that I actually shared from the stage last year at one of the industry events, that fewer than 1 in 10 RIA firms with $5 billion in assets or more has a CMO or a senior VP of marketing type person installed. Now, that number could have changed over the last year, but even if that number doubled, you're still talking about fewer than one in 5, right? So you think about growth, whether it's organic or acquisitive, is probably the number one priority of most firms in terms of their business, and they don't have leadership installed. And part of me thinks it's also because there isn't the talent that's been cultivated and invested in, right? The career track development. But I'm curious to see what your observations are, gentlemen, in terms of as you look at this. I mean, Toby, do you feel like you're running into more CMOs out there? Do you feel like the discussion comes up? What's your observation on it?
Well, I do, but still there is this profession of rugged individualists. And we say that lovingly because rugged individualism is one of the founding principles of this country. But advisors tend to have this sense that they need to do everything in their firm, and that's understandable. They're running a small business. They need to create a sustainable enterprise that can build upon itself. And they are oftentimes, very appealing speakers in public, and people connect with them. And that is not in any way taking away from it. But the problem is there get to be too many tasks for an advisor, especially at a small business, to be able to try to juggle all of these things while they're doing compliance, payroll, admin, any number of other tasks. This is something that's just eating away at their time more and more. And there is this just wide disparity, even among firms of a massive size. You brought up those $5 billion firms without CMOs. I can tell you, a lot of times industry people like to hear like the behind the scenes story of how stories happen. And I can just share, I was reaching out to 2 firms over the past few weeks for this story. And they're both very large firms. One is much bigger than the other, but they're both very large firms. The first firm, they had no one on the website for any reporters to call. They listed no one in marketing. They listed no press contact. They had the only email contact they had was info@firmname.com. And
not very helpful.
No, not very helpful. So, but I went along with it. I sent the email to the generic email, and of course I didn't hear back. You don't really expect to hear back when you send to one of those. And so I called someone there. The person who answered the phone, understandably, really didn't know who to send a reporter to. They probably had never even heard of my publication, which, look, we are well known in the industry, but not everyone in the industry knows us. We're not the New York Times calling. So this person didn't know who to send me to. And I wound up speaking with someone in HR who initially said that they were the wrong person, but they could take a message. And I was trying to leave that message. And all of a sudden, this person felt very hostile toward me and just hung up the phone in the middle of the conversation. I swear I wasn't saying anything offensive or trying to find social security numbers or whatever. But anyway, they just hung up on me. So, look, sometimes as a reporter, people don't want to talk to you. That's fine. But the other firm that I reached out to, they had a press contact. They immediately got to scheduling an interview. And look, in the final story, one firm is in the story and the other firm is not in the story. And that's not to toot my own horn and say, if you're not in my story, you're not cool or something, or it's certainly not to suggest that I'm cool. I just thought it was remarkable that a firm that had, I would estimate at least a few $1 billion in assets under management, had no one there who even knew how to field a media inquiry.
Be an ambassador for the firm.
Yes.
I mean, yeah, it's crazy. All right, so Ian, we heard Toby's story about his run-ins with the lack of marketing comms contacts. You have your own story about what it was like trying to sleuth out a story with hard to find contacts. Tell us about it.
Yeah, so I think that this is probably an object lesson that if you are an RIA listening to this, you should probably have someone on staff who knows how to talk to a reporter. So for context, a couple of years ago, I had from some of my sources, they told me definitively that this large wealth manager was selling. I had the name of the investment banker. And typically when I get that, it's a lock, it's game on. I go to the investment bank for comment, they decline to comment. And then I go to the seller's website and there is no media contact. There's no marketing person. There's no, as Tobias described, there's no info@xyz.com, even though that's a black hole. But what there is a direct contact for the CEO. And so I email the CEO, say, hey, this is what I've heard. I know you can't say too much, but we're going with this. And he panics and he denies that there's a sale happening. And he claims that the investment bankers are probably lying and leaking this to put pressure on him to hire somebody and sell. And so I trust my sources, but I've never been in this situation where the denial is coming straight from the horse's mouth. I pause, we hold the story, but I have a feeling he's probably lying to me. And sure enough, he was actively lying to my face. They were selling, and they sold to a firm where I actually knew the chief marketing officer well. And he ended up arranging an incredibly awkward interview between myself and the selling party. And I will say, another point in favor of having a truthful relationship is that after the fact, the CMO, who I have a good relationship with and still do, asked if I could remove a true element of the seller's biography from the story. And you can imagine that I declined that request.
Gotcha. Well, it's a lesson to be learned. And I think one of the takeaways I'd encourage the audience, anyone's listening, to think about is, again, when you're talking about representing your firm, whether it's from a marketing standpoint, a communications or PR standpoint, make sure you have someone in the seat that knows the rules of the road and how to comport themselves with integrity. So those are both good anecdotes. And you start thinking about it. There is a challenge there, right? We think about this, going back to the first question I had, how much pressure is on the whole organic growth machine because of deal making. I think it creates another cascade effect of now firms, if you're really going to get on board with this, you need to groom talent, not just up and coming advisors and things like that to help support the organic growth and new clients coming in, but also people that can drive that and run with that, and are actually specialists, because we're no longer talking about a cottage industry anymore. Right? It's when I first started doing this 25 years ago, if you had $250 million, you were doing pretty good. Now they're talking about even the SEC redefining what a small firm is and putting numbers like $1 billion attached to that threshold. And so you start thinking about that's changed quite a bit, which leads me to another question, which I think you both would have an interesting perspective on, which is, will there be a true household name RIA firm? And not just names that you and I all know, three of us all know, but in terms of the rank and file mom and pop investor, like how soon do you think we see something like that, given how fast industry has grown? Do you think we see one in 5 years, 20 years? Any sense? And who do you think? What are some of the firms you're seeing that you think might have a play for that? Ian, since you answered second last time, you go first here.
Yeah, I mean, I think that we can see this in 5 to 10 years. And to your point, I mean, there are some firms that have taken incremental steps, baby steps, if you will, towards it. I still remember watching the NCAA tournament in 2019, and Creative Planning was a sponsor. They have commercials now. Edelman Financial Engines has commercials. The CFP board has commercials. Even LPL Financial, they hired Anna Kendrick. And that's a business to business facing business to business facing company that doesn't really recruit end clients, but they hired one of the most famous actresses in the world. I just think, think about how big Charles Schwab is and how big their marketing budget is. Eventually, as these firms scale up, again, like I always kind of liken this industry to the insurance brokerage space, where we saw similar private equity backed consolidation. And a lot of those consolidated firms, those roll-ups, are quasi-household names. I mean, the Pittsburgh Steelers renamed their stadium after an insurance brokerage roll-up, Acrisure. So if you're telling me in 5, 10 years from now that we'll have some of these mega national firms get to the level where they can sponsor an NFL stadium or buy an ad during the Super Bowl or run a campaign that has a recognizable character like the broker in the Schwab campaigns? Yeah, I think that's totally possible. Who do I think can get there? I mean, I mentioned a couple already, but it wouldn't shock me if someone like the wealth enhancement group, the wealth enhancements of the world, they're the Mercers, are nearing $1 trillion in assets and have the money to burn.
Yeah, that's a good perspective. And Toby, how would you answer that?
Well, I wouldn't disagree other than just pushing back on the idea that it would just be one firm, because as you pointed out, these firms have that dry powder to invest in this marketing. Many of them already are. And, when they're doing that, they're going up against people who are already investing tens of millions per year in marketing to begin with. So it's going to be tough to catch up with a lot of the firms that we already see with their names on stadiums, such as my continual Google alert problem with Raymond James Stadium and Lincoln Financial Field. It's just an industry where people spend a lot of money on marketing. And that's not to say that they shouldn't. And as we've been discussing, advertising is only one aspect of that. I think the firms that are going to put themselves ahead are the ones who are going to be investing in all of the different areas of marketing. I was referring earlier to this report that I covered last month out of Catchlight. They're a fidelity investments startup. They do data analytics around lead generation for financial advisors, and their research among Barron's top 100 firms. I state our other competitor, Barron's, because they look specifically at firms that were large enough to be recognized by Barron's as a top 100. They said that all of these firms need to spend at least 5% or more of their annual revenue on various types of marketing. So the firms that get ahead of it by doing that really put themselves in a position to be those household names. And I do agree with Ian that you're going to hear more of those names, and I think it'll be a different set of the traditional from the traditional wealth management names that come to mind for people from all the different commercials they already see already.
Well, and I think you're right when you talk about the creation of a household name is going to have to be something more than just advertising, right? Obviously, you can throw your name on a stadium. You can, I think I've seen Correspondent, for example, do a lot of Bloomberg TV ads and those sponsor segments on CNBC. And those are important, impactful broadcast outlets, but still you only maybe get 100, 200,000 people watching at any given time. So it's not ubiquitous like watching the Super Bowl. And I think that transcendent moment when you do have the Final Four or a Super Bowl ad, that kind of level event, that seeing the name attached, you can see some teams, some firms taking the plunge in that direction. But again, it's also repeated. You have to sort of carry that through. Like Coke and Pepsi didn't become Coke and Pepsi overnight. And so I kind of feel like you'll see this phase, but it's often talked about because within our space, I think the RIA world seems kind of small. A lot of times, three of us could be talking and we'll be able to rattle off 15 or 20 really notable names that are doing good stuff and really growing quickly, but the average person has no idea who these firms are. And so it's something to keep an eye on, and something where I think as the money flows more and more into this space, and then you get these firms that go from scale from 10 billion to 100 billion to a trillion, as you talked about, you start talking about pathways for that to happen. Now let's shift into another line of questions, because this is a little bit maybe more in your wheelhouse every day. And when people start thinking about telling their story and building their brand, they're obviously thinking about, in part, can we get the media to cover us, talk about us, help us build our profile? And if you're in the business of recruiting advisors or doing deals, certainly your publications are places that make sense for that growth effort. Humor me for a second. Give your best do's and don'ts for engagement in terms of, all right, if you're a firm that's trying to be a good partner and share in the publicity that your publications provide, what are some recommendations or ideas you would give? Or maybe you have a story that sort of portrays how to do it successfully, or what to avoid. Toby, you're smiling already. I'll give you first crack at this one. What would you say for someone who's looking to add brand visibility and media relations to their mix for bringing their brand to the forefront?
I would say number one, don't give up. So if a release, an announcement goes out and it didn't receive the coverage or notice that you wanted on that particular one, well, that one didn't work out, but there's another one coming. So don't think that this is over or that no one is interested. Usually it's just the fact that there are a million things happening each day, and we're spread a little bit thin trying to get stories to the finish line each and every day. And we maybe didn't have a chance to look over every email or didn't respond. But other people may disagree. I never mind getting another email. And you can start that relationship any way that you like. I think I've learned of so many different experts who have just kind of emailed me out of the blue and said, hey, I read this story that you wrote. And they didn't just it wasn't an AI generated, I read XYZ story, it was good. They, it's not that they, took some master's thesis on, on some story I wrote, but they pointed to a particular thing, and sometimes they said, hey, I don't think you quite got it all here, or you might have missed something there. We laughed a bit about the basic biographical details that they pushed back against, but we do value reader feedback very much. And especially when we hear from people in the industry that, you could have had some more context about this fact, or this is a little bit different in my experience. This works differently this way. I think we're very receptive to that, and we're always looking for expert insights. And so maybe this isn't that cover of Fortune magazine or big profile in the Wall Street Journal that maybe any of us would like to have at one time or another. But this is something where we're recognizing you as an expert in this field. Our audience badly needs that. Our audience is badly interested in other people's experiences. And, we are talking about your firm's recent expansion, and that's why you're an expert in whatever we're talking about. So that's why my main message is always, don't give up. And then also, I'm sorry if I didn't get back to you in time, because there is so much happening out there, and every single advisor has an interesting story to tell about how they got into this industry and what motivates them to help clients every day.
Good stuff, Toby. Now, Ian, how would you answer that in terms of rules of engagement? How to win this slice of the storytelling pie? Any guidance or ideas or examples?
Well, I think it's kind of like being an advisor at the end of the day, which is that we talk about how we can systematize or kind of automate some of the elements of the marketing process, automate prospecting, scale this stuff up rapidly. These businesses have massive multi-billion-dollar valuations because of the idea that we can scale this stuff up rapidly. But at the end of the day, it's all dependent on the deeply personal human relationship between the advisor and a prospect or a client, which is one that's based on trust. And the relationship between a spokesperson or a PR representative or a marketing executive and a journalist is one that's based on trust at the end of the day. And so it's one of those situations where if you build up credibility with me, then I'll build up credibility with you and treat you as an honest broker. And frankly, I mean, there's a lot of times it relies on kind of mutual understanding, which is that a lot of times I'm going to come to you with a request for comment or a story that probably is not necessarily aligned with your interests or blows up a marketing plan that you had. But if you're able to work with me fairly, then I'll trust you in the future. And yeah, maybe I am more inclined to listen if you pitch me on a feature. So I think that it's about having the kind of open line of communication and dialogue that kind of underlies everything.
Well, that's great advice. And I think when obviously, whether it's publicity or advertising, there's a couple forums that seem to have an outsized impact in terms of how people show up out there. And so understanding how to work with people in your shoes goes a long way for them. So let's get one last sort of big topic before I set you up for a parting shot. And just so you know, if you haven't watched these episodes before, the end of these pods, we ask each guest for their takeaway or parting shot. So start thinking about that in the back of your minds. But before we get to that, I want to point in another direction. Ian sort of alluded to in his show notes here as we got ready for this, was the idea that we're seeing money in motion towards marketing platforms. Like the report out that Robert Sophia's Snappy Kraken was for sale. FMG just bought Testimonial IQ. And quickly rebrand that to FMG Testimonials, right? So that's another platform, right? And so now you've got at least two of those deals out there. And then not to mention the fact, so Gregory's been around a long time doing this work supporting, but I just look over my shoulder in the last 6 years, there's probably 24 agencies, either marketing or PR or a mix of that have sprung up to support this space. So there's also new capital, new entrepreneurs in this space trying to help these firms market and grow. And so when you see this level of money in motion, what do you think it portends? Like first, Ian, I know you brought this up, so I want you to go first. Like first, when you see those headlines about those tech platforms being involved in deals, what do you think? And sort of like, what do you think the sort of trajectory is given what you've seen in terms of new businesses springing up to support this, as well as companies in motion like that?
Well, first, thank you for the oblique shout out. Appreciate it. We also broke the FMG sale process. But I think what's interesting is that those are firms that kind of build themselves as technology first. And I think so. I'm going to be the one who makes the shameless pivot to AI. Is that I do think that you can use AI to, God, I sound like a Silicon Valley character. You can use AI to quote unquote disrupt a lot of elements of programmatic marketing campaigns, right? Like you can use ChatGPT to auto generate a prospecting email that'll get sent out to a couple of thousand people. You can use it to schedule or build an email. So yeah, if you're running it based on pure technology, it makes sense that it's going to get disrupted. But at the same time, I can detect if something's written by AI fairly quickly, and you kind of move to dismiss it. So it almost places a premium on people who are willing to put in the actual labor to really prospect. So like when I get a pitch from a PR person that it's very obvious that they did research on either me personally or the company and actually put effort in, even if it's going to be a pass for us, I'll at least give it a real deep read that it deserves because they tried. But if I see a PR email that's clearly automatically generated using similar technology to an FMG or a Snappy Kraken, and I see they didn't even bother to fill out the blank to put the journalist's first name in, you're automatically going in the trash. And so I think, yes, there's technological disruption, but I think that it opens the door for people who go the extra mile to, I'll use another Silicon Valley style cliche, to win disproportionately.
Well said. And Toby, what do you make of all those headlines when you see these firms on the move and where the money's chasing these marketing tech plays?
Well, I think they're only going to continue to accelerate, and you will see more and more of the so-called incumbents of wealth management investing in them as a means of bringing those services to bear across their base of advisors. For advisors, I've had a lot of smart advisors and other experts in this field say there's a lot of need for discipline at a time like this because the number of fintech firms that want to work with advisors in some way just keeps getting bigger and bigger. So you want to choose wisely with the vendors that you use, and that's whether you're a standalone independent RIA or whether you use a broker dealer or another. Firm with a more national scale to help you with your technology. What are the key capabilities that you want to focus on, and what is the service that is going to get you the furthest along without adding too much to your expenses? But I think we're only going to see more and more M&A deals. That was an acronym I thought I didn't really even know about until I came into this field in 2017, and now it just keeps picking up year after year, whether it's in terms of direct wealth management, M&A, or more of these picks and shovels among service providers with fintech, but any number of other types of service providers as well.
Well, one of the things that two of you didn't say pointedly here, and I think, to Ian's pivot to AI, is that there are certain business models in the marketing tech stack world that are going to be disrupted, as Ian said, but to the point where if you're owning equity in those companies, you may think about trying to capture what you can while you still can, because there might be other tools that quickly take you out of business or limit your upside. The also interesting part is, like, I think a lot of times best marketing technology, even if it does a lot of tasks for marketers or short circuits it, you still need the tip of the spear, the marketers in place to run the programs and make it work for your company, make the content connect with your audience and so forth. So in some ways, the reduced costs perhaps that might come with this disruption on the marketing technology, maybe it could be that money could be moved into hiring a marketing director or CMO at those firms that don't have those people in order to be able to make sure that the content or the ideas or campaigns that get kicked out actually speak to the people you're trying to engage. And so I think in some ways, the reduction of costs delivered by technology might actually afford more budget to add talent and invest in that piece of the business for marketers. So let's do this. So we're running towards the end here, end of the pod. I always ask our guests, it's a chance for a parting shot, some outlook piece you have as it relates to your business, topic of marketing or growth, ideas or things you're just looking for trending in the industry. It may have nothing to do with marketing, but something where people watching this, you're going to leave them with something. Your chance is to put a word out there. I'd love for you to both weigh in and give us your own parting shot. Toby, I'll pick on you first.
Well, this month at Financial Planning, we're focusing on professional development of financial advisor talent and other wealth management professional talent. And all the experts are telling us the firms that are investing in that area are also getting ahead of so many different challenges that are facing the profession, facing the industry. Succession planning is no small thing. There are a lot of advisors out there still, I'm told, who don't have fully developed succession plans. And the interesting part about it is that it's not only important to the future of their business, if they would like to remain a standalone independent business instead of selling to one of the aggregators out there, and they want to have an internal successor, they need to recruit young people, career changers, and make sure that they prepare ahead of time. It's not something as all the RIA owners out there know that it doesn't happen overnight. So it's something that they need to prepare for. And the firms that are doing it are also becoming multi-generational among their client base as well. So there are so many incentives to invest in the next generation of advisors, and we're trying to help our audience do that this month at FP.
Awesome. And Ian, your turn.
I think the big macro trend that I think about is the IPO. And that's the other thing that's been kind of unsaid throughout all this is we talk about kind of the mega scalers. Who's going to be the first person to take the step into going public, and what effects will that have? Because I think, as any marketing agent would know, the types of obligations that you have, and compliance obligations and compliance risks you have running marketing for a public company as opposed to a private are completely different, and that requires a whole new level of investment. So that's an angle I'd like to explore a little bit more.
Well, I think when you take a look at the IPO, I think it goes back to the household name. To get the most money in an IPO, you're going to have a market that really understands the unique value proposition of an independent wealth management platform, the RIA style business, to the point where they can see why it matters to be public, and we support that from a investment banker's perspective. Is those brands that have the same kind of name that Morgan Stanley and Merrill Lynch have enjoyed for the last 100 years in terms of being reflexively known. I think, to your point, Ian, it's something to watch out for. And so, again, gentlemen, really appreciate you taking some time out to give your color and perspective from the reporter's perspective. Thank you both for taking time. And again, this does it for another episode of Marketing Matchup. Again, I'm your host, Joe Anthony. Thanks again to Tobias Salinger from Financial Planning and Ian Wenik from Citywire.
Thanks again.
Thanks for listening to Marketing Matchup, a production of Gregory. If you like what you heard, please listen and subscribe wherever you get your podcasts.